Okay, folks, if we take a look at some of these yen pairs, we can see that we've got a clear sell bias. We've gone through it a few different times on the macro trade ideas. Swiss franc, Japanese yen, we've got a clear sell bias with the divergence between the SMB and the Bank of Japan. Similarly, with the euro yen, we've got a clear sell bias in the euro yen pair, with the ECB looking at ending their hiking cycle, the Bank of Japan about to start theirs. And similarly with the pound yen, we've got exactly the same with the Bank of England and the Bank of Japan. And we've covered a few separate trade ideas with these yen pairs. Now, the real weakness you have to be aware of with macro trading FX is there's two weaknesses. The first weakness is that you can get direction right, you can get the narrative right, but you can get the timing wrong. So, if you looked at this sort of somewhat dispassionately, you could say, well, okay, hang on, the Bank of Japan was looking at potentially exiting negative interest rates. It wouldn't have been unreasonable to start expecting that from December 2022 last year, okay? But then look how far the yen has weakened since then. Now, I know we're looking at this against the euro, and there's obviously what's going on in the eurozone as well. But just ignore that for a second, because the point stands regardless. You can see that the pairs weakened, with the yen against the euro has weakened another 15+%. So that means if you were sort of banking on the Bank of Japan exiting negative interest rates, and you were looking at euro yen short, which wouldn't have been an unreasonable point of view from a macro perspective over the longer term, right? You'd have been sort of heavily underwater in a massive drawdown. So what you have to be aware of, and then you might have said, the further price goes, oh great, this is a better price to get in. And that's one of the weaknesses with macro FX. The further the price goes against you, the better value it is. So all that means is there's two things. Is if you haven't managed risk well, this will affect your psychology. Because let's say, you've been selling the yen from this level here, 1.5 on the big macro narrative. And let's say, you initially had your stop of like 250 points, and then price moved up 250 points. You think, the narrative hasn't changed. It's just a question of time before it goes, in my direction. Then, okay, 162, 163, 164. And then what can happen, and this is the real danger, is say the narrative does definitely change, and the Bank of Japan, for whatever reason, is not going to exit ultra loose monetary policy, and the ECB turns really hawkish. What would you expect then? Then you'd expect the euro yen to continue moving higher. But the problem is, because you're maybe 500, 600 points in drawdown, psychologically, you run the risk of just being in denial. And it is a psychological risk. And you might think, oh, that's just ridiculous. Yes, it is ridiculous when you're not in the trade and when you're talking about it and looking at like this. When you're actually in the trade, the impact of the capital at risk alters your ability to think logically, and you become much more, or you could become much more emotional. So you just have to be aware of that dynamic. So what that means, like for this euro yen, say, we get the euro yen, or let's just look at the pound yen, because that's the one we looked at this morning. Let's say, for the sake of argument, right, we get a hawkish Fed, and pound yen shoots up to 186. Okay. Now, the way to get around it is to say, okay, I have got a pound yen sell bias, and I'm going to limit risk to this one pivot point on the weekly chart. That's the space I'm going to give it. Now, there's all sorts of other little clever tricks you could use here. You could, you could enter the short here, and you got your stop above that level. But say sort of price sort of starts meandering up here, and you're just not happy. You're a bit worried that it's going to keep going up. You could close it and then have a sell on stop back at that R1. So when you're taken back in when it's moving in your direction. But otherwise, just say that's your stop. And then let's say in 6 months' time, the pound yen is down at 155. But the problem with FX, and it's particularly in FX markets, they're very volatile. So there's, you might get, a a sharp run up to 194, 195, and then a very heavy sell off. So the way around that is just to be aware, just think, hang on, if I entered up market there, I've reasonably got to have my stop above this R2 pivot point, and then what could I reasonably expect? Maybe a run down to 168, and then there's all sorts of tests of that narrative as we go. So is it really worth the risk? No. Okay. Is it such a compelling narrative right now that, yeah, okay, I can take the higher risk because the narrative is so compelling? No. Where is it a marriage between a compelling narrative and an acceptable risk? I would argue, for me personally, it's up at that 186 region. That's acceptable. Okay. And you've also got a little bit of room above those highs in case you get a little fake out. You've just got it above that R2 pivot point. So that's very, very reasonable. So just to be aware, to summarize, the two big weaknesses: one, you can be right about the narrative, wrong about the timing. Two, FX markets are very volatile, so make sure you have managed risk completely. And it's absolutely fine, finally, to potentially re-enter the market. Okay, so you can think there and think, okay, that's the risk I was happy to take. I'll take that. Now I can look for potentials to re-enter and then reassess. Or you could say, okay, I'm going to go with a break of this trend line as we discussed earlier, etc. And I can just, as long as I stay below that trend line, stay with the trade, get back above it, I can get out. You can just keep managing risk like that. So it's just a weakness with macro trading that you must know about and must embrace, because if you don't, and I've seen it before, people have had very strong, very good, strong track records. They're nursing a position in drawdown, but they're convinced it's going to turn around. And then when the narrative shifts, they have difficulty changing their point of view. Understandably so, right? It's completely understandable because you just don't want to accept it, especially if the higher the drawdown you are, the worse it is. So just make sure you're thinking, okay, what's the worst case scenario? And then, am I happy with that worst case scenario? Like, as in, am I completely resigned to that? And that's the place you need to be in. And then, potentially that could, run to be a decent gain. You could trail stop, and you're just in a much more controlled position in that kind of scenario.